Hi everyone. Thanks again for joining me in our journey to learn how to use R for finance applications. Now, before I get started on this video, before we get too deep into the weeds, I just want to highlight that this video is about technical analysis, and I would not consider myself a technical analyst by any means whatsoever. So I don't want you to think that this is a video telling you how to invest with technical analysis or giving you stock tips or anything like that, because that is not me. There are plenty of resources available online. There are books that are written, there are articles, websites, videos, all devoted to this technique, and they are all going to be infinitely better than I am. This video is just meant to show you that you can use R as a tool in your technical analysis repertoire. Now, with that said, before um, we get into the R side of this, or as we're getting into the R side of this, I just want to highlight that before you work on this code, definitely make sure that you've installed the tidyquant package. So this brings in a lot of great finance-oriented functions, and I have found just in my limited time using it that it is phenomenal. It has a lot of great functions, a lot of great functionalities that will extend your use of R across many applications. Now, you may have some issues downloading it. I've done this on two different computers and I had the same issues, and they both had to do both errors on both computers focused on the time TK and per packages needing to be updated. So it's probably a good idea just for you to install these two packages before starting a new session and before installing the tidyquant package. Now, with that said, um, let's just jump into it. So we're going to use the tidyquant package, the tidyverse package, Lubridate, and we are going to be using SQL in this because we're going to be doing some joins on daily data. So make sure that you include the SQL library, ReadXL, Fixtest, and the Broom packages. As always, make sure to set a working directory, and from here you're ready to hit the ground running. Before we do anything else, though, let's make sure we have the Fama French factors pulled in. Now, in fair disclosure, we're not going to do much with the factors in this video, but it's good practice to include factors in the data just in case there's a possibility we might be using them for any purpose. And specifically, the factors I care about here are the Fama French daily factors. So in a previous video, we used the monthly factors, or sorry, I think it was the annual factors, um, which in order to get these, you will also go to Ken French's website, where he very generously provides his data for free, and just look for the daily data file. We will need to format the date to make it look a little bit nicer. We'll use Lubridate's YMD function, which simply just, in this case, we'll just add hyphens between the month and the year and the month and the day. And we will also mutate the data to include a trading day identifier. So I've already run this, and I'll explain the reason why. But whenever you run it, essentially what you're going to be doing is cleaning the date column and also essentially assigning a unique observation to each day. And what this is going to do is allow us to provide better matches whenever we use SQL. From here, we'll dive into some of the most powerful some of the most powerful features that I've come across in the tidyquants package library. So the first two things I want to point out are TQ index options and TQ exchange options. If we run this, you'll notice we're given some strings that say Dow, Dow Global, SP400, SP500, SP600 for the index options, and Amex, NASDAQ, and NYSE for the exchange options. So that in and of itself doesn't tell you very much until you recognize tidyquant has a function called TQ index. And what this function does, is provide you, whenever you run it, a database of the current constituents of an exchange or of an index. So what I, for example, what my line 23 does is take the SP500 option, I feed it into the TQ index command, and it provides me a data set of all of the current constituents for the S&P 500, which is a little bit over 500 entities. Now you could do this for the S&P 400, the Dow Jones Index, the SP 600 Index, or you could try to get a near current universe of, of constituents by doing this for the Amex exchange, the NASDAQ exchange, and the NYSE exchange. The reason this is important is because we could tell R to take a unique or identify all the unique symbols or the tickers within the current constituent data sets, which is what I call this object, current const. And you'll notice if I run this, it gives me the 504 unique tickers. This is going to be super important because we can use tidyquant's tqget commands on the object of strings and get a panel of stock prices from Yahoo Finance or Google Stocks or a handful of other data providers that have APIs, and we can pull all of this in at the same time for all of these different stocks over a time period that we care about. Now for this example, this is going to be a larger data set, or this is a larger data set. So just for the sake of this video, I ran the tqget function on the list of current constituents, or the object of current constituents, only going back to only the beginning of 2023. Now to be super specific for returns and things along those lines, I should have gone back to 2022, like December 28th, 2022, somewhere thereabout, so that way I could get the last day of returns, so that way I can have a full time series of returns across each of these years for each of the assets within the index. But this is just for simplicity's sake. When you're doing this in practice, make sure you always get a previous day's return. And one thing I want to note here is you can change the get option to instead pull dividends, stock splits, or economic data from FRED, which is the Federal Reserve's economic database. And that in of itself is cool and all until you recognize how powerful this package really is. So I went ahead and downloaded this data prior to starting this video because I didn't want to waste time in the download. Depending on your internet speed, this could take anywhere from a couple minutes to an hour, depending on how long your time series is. But for mine, being I think it was just over a year for the 504 firms, it took about 2 minutes. You'll notice I have Microsoft's data going back to the beginning of 2023, BAC, APH. I have all of these firms, which makes sense because what we've done is downloaded all of these firms' pricing data over the time series for every firm within the S&P 500 index, which is so powerful because now that you know this, you don't have to input the ticker for every single stock that you care about, unless you just want to. And on the back end, this is pulling the Yahoo Finance R package, which we've used in previous videos. But I do want to reiterate, if you have access to paid APIs, you can use this function. If you want to get data from Google Stocks, you can use this function. Super powerful. I highly encourage you to use it in the future. Now, like I said earlier, it is always good practice to deal with or to incorporate factors if you're thinking about doing anything with asset pricing. So what we're going to do now is in line 30, use a left join to bring over our Fama fringe factors to each and every single asset on the same day. Now, with that said, you'll notice that in lines 32 through 34, we have a SQL command where we're going to be dealing with some T days. I haven't done anything in the equity panel currently to include T days. If I wanted to, I could go ahead and mutate each of these days to have a trading day, but I remember my Fama fringe factors dataset has T day, so with my foresight knowing I am going to use this in a little bit, I am not going to want to join over just the factors from the Fama fringe factors dataset. I want to include pretty much everything. Or actually, I do want to include everything. So that's where this left join statement is going to come from. I'm going to join on only the dates, which means in my equity panel dataset, what R is going to do is look for the commonalities for every date between these two datasets, which our joins are going to be happening on closer to the end of it, like in this space. And it's going to say, hey, if it matches on this date, I'm going to bring over each of these columns. The market risk-free column, S&B, HML, risk-free, and then also the T-day identifiers. I can run this, and now notice I have my factors for each column and a trading day identifier for each assets trading day, which is what we want. Because now what we're going to do is identify the lagged values for each asset's prices. Now in past videos we've used the lag function, and I've put in the word of warning that the lag function is great. However, you need to be careful with it if you don't have a full time series of data. Now for the S&P 500 firms, these are going to be more liquid, which means they're going to be traded pretty much every day throughout the whole day. However, whenever we start dealing with the near universe of firms across like an exchange or just over time, not every firm is going to be traded at the same rate as every other firm. There are going to be some firms that are not traded, or their stocks are not going to be traded as frequently, which means the lag function may not give you the true last price of an asset, especially if you're using like the CRISP dataset, the CRISP database. So what we're going to do then is make sure, if I pull this dataset back up, we use not dates to identify the lags, but we use trading days. Because some datasets, if an asset is not traded, it will not populate with open prices or low prices or closed prices or adjusted prices. It'll just have a dot or say NA. So really what you would want is not the true lag value, but rather the last day with populated data, because the price doesn't go from being worth something to absolutely nothing unless like some other major firm event occurred. So that's where these trading day identifiers come in handy, or the month no identifiers come in handy, or year identifiers that we used before will come in handy. And what we're going to do, because we want lags of every single asset's previously traded value, is we're going to use the SQL df function and say we want to base our commands on the equity panel objects, and we're going to match each ticker to itself because we don't want any sort of cross-contamination across assets, and match the current day's trading day to a lagged trading day. But the only data that I really care about here is the adjusted column. We could take a lag of the open prices, the high prices, the low prices, the close prices, volume, adjusted. We can even take lagged factors if you want. But for this video, only thing I'm going to care about are lag prices. Before we used close prices in previous videos, but let's use the adjusted values in this video because it's going to be a little more accurate to what the true price is, because the adjusted column or the adjusted data in Yahoo Finance, which is the ultimate source of the data here, accounts for dividends and stock splits that occur in a company's past. So, with that said, the SQL code is going to tell us this. We're going to select everything from one data set, one column from another, and we're going to rename it to lag of whatever that column is. Or you could just say lag, or name it anything you want. The first data set is the equity panel object. I'm going to abbreviate it as A, and then I'm going to inner join, which means I'm going to keep only the rows that have matches, the same data set, the same object, which I will also nickname B. I'm going to match on the tickers and say match on the days, but the second data set needs to be data from one day prior, which is what the +1 indicates. From here, we're going to do some simple adjustments that we would normally make when dealing with this type of data. Extract the month identifier, the year, the date, assign a unique month no to each observation. So because we're dealing with daily trading data, we're going to have at least 20 days within each month with the same month no for each asset. Then we're going to compute a holding period return for each adjusted value, or based off of each adjusted value, where the return is the current adjusted less the lag adjusted divided by the lag. And then the XRET column is just going to be the returns for that day over the risk-free rate, which comes from the Fama French dataset. Now, this is a lot of data and may take a second for your computer to run. Don't be alarmed. Don't try to stop it. Your computer is just thinking. So now if we open this, you'll notice we have all of this data with unique returns and unique excess returns for each and every day for every asset. Now, what about technical analysis? Everything that we've discussed so far is more just data cleaning and data wrangling, and also tips on how to get new good data for your projects. Well, this next step in line 42 through 46, this is where technical analysis is going to start coming into play. If you look in lines 44 through 46, we have a function called SMA. This is one of tidyquant's functions to compute a simple moving average, which is pretty straightforward. The idea of a moving average is that we're computing an average that's going to change for each and every day based off of the window that we want to compute an average. Typically these are rolling windows, but you can also have a moving average based off of a center point. In this case, I believe it's a trailing average, where if you want a 10-day moving average, every day's 10-day moving average is going to be based off of the current and the previous 9 days pricing points. If you want a 45-day average, it would be the previous 44 days plus the current trading days. But you can define them however you want, which whenever you get familiar with the programming aspects, that's something that you can do. You just need to be able to justify your mathematical computations. But one thing that's super important for me to pay attention to, pay a little bit of homage here to, is line 43, which includes the group by symbol statement. And what this is telling R to do is everything in this following mutate step, make sure you're keeping your computations only within the same ticker. If you don't include this, what's going to happen is R is going to just take the previous 10 or the previous 9 observations and average them together, which is not what you want. Because as you get closer to the end of one asset's time series, I can give an example of this. We'll use Microsoft. As you get closer to the end of one time series, you don't want to include data from another asset. So for example, if you don't include the group by statement, whenever R gets to line 271, it's going to include data from Microsoft. But with the group by statement, it recognizes that this is a new set of data for a different firm, so it's not going to populate for Apple's moving averages until you have the requisite number of data being pulled into the moving average. So for these first n rows, it will have no moving average. Now for the sake of simplicity, I have used the SMA function for a 10-day window, a 30-day window, and a 45-day window. In practice, these can be anything. It could be 20 days, 250 days, if you want closer to a year moving average, or a half a year average. It's all up to you and what you need to justify for your technical analysis. But let me point out these moving average functions. So this first panel is on Microsoft, and exactly what I said makes sense, or is exactly what I said is shown here, where for a 10-day moving average, I don't have any data populated before the, let's count them, 1st, 2nd, 3rd, 4th, 5th, 6th, 7th, 8th, 9th, 10th day. So the 10-day moving average has 9 missing values beforehand because there were not 10 days worth of data being fed into the simple moving average function. For the MA30 column, we won't see any data appear until the 30th observation. And then for MA45, we will not see anything before the 45th observation. These are going to come in handy here in a minute whenever we plot moving averages against the daily price data for a certain firm. And now lines 48 through 52 are another SQL command, but this is a super important SQL command. Super important, especially if you care anything about technical trading strategies. What this is doing is computing momentum, which, remember, momentum is just the idea that stocks which are winning or doing well will continue to do well, and stocks that are losing or performing poorly will continue to perform poorly. The idea is simple and straightforward, but how to compute it is a little bit different. In the back end, we know we want to have some sort of geometric average of daily returns to compute how firms are performing over a period. And you can find functions to do this. There are functions where you can say compute momentum of this column over a certain time period. But it's difficult to really know how they're computing it on the back end. For example, the functions a lot of times are not clear if they're computing momentum over a rolling window or if they are computing momentum with the current day price or just the previous trailing prices. So this is where SQL comes in handy, because you have a lot of say over how momentum is computed. And this is something you can do if you want to define your own moving average functions as well. But whenever I compute momentum, a lot of times I will not want to include the current day's price, because just for my own analyses, I care about trailing prices or trailing momentum. So let's break down the SQL code and I'll show you what I mean. We have SQL df, which just tells R to run SQL. And what I have afterward is commands telling it to select all distinct observations with all variables from my first data set A, which I am using equity panel 2 as, and then I'm going to create two columns, mom30 for momentum 30, and a count column that tells me the number of observations used to compute my momentum variable. I define momentum as a geometric average of returns, and like before, whenever I was joining factors over, I'm going to tell SQL, or tell R here, to make sure I am computing momentum based on data only from the same ticker. So I don't want trading data from Microsoft being in Apple data. And I don't, I don't want Apple data being mixed in with Microsoft data. I want it all to be based on the same symbol. And I want to base my computation only on the 30 days prior of trading data. And I do not want to include the current day's data as well. So I'm looking for a trailing momentum computation. And this group by a.symbol and group by a.tday is just telling SQL to make your computations within a symbol grouping and a trading day grouping. So this keeps you from the cross-contamination of assets, and this is going to give us a unique momentum for every single trading day that has at least 30 days worth of, or it's going to give us a unique momentum for every single trading day. We'll just leave it there. Alrighty, and if we run this, it might take a second. And then we'll see what exactly is going on here. Momentum computations do tend to be a little more intensive. So if you have a lot of data, especially if you have a longer time series of data that you're computing momentum on, your computer will more than likely need to take a second to breathe and figure it out. But if we pull up Equity Panel 2 again, if you look here, we have a momentum column for a lot of these rows, but really the only thing that the values of momentum that we may care about are those with at least 30 days worth of previous data. So notice R has computed momentum for every trading day where it has at least one previous day's return. But in your analysis, you may care only about, let's see, these observations down here, because it actually has a fully defined momentum computation. Alright, now with that said, one of the things about technical analysis is you can make an argument for whatever you think is correct, whatever information you think is going to be profitable to trade on. Now, some of the more common strategies used in technical analysis are the moving averages, momentum, let's see, using Bollinger Bands. Like, there are a lot of different strategies. I'm not going to do anything with momentum. I just want to show you how to compute it. But I am going to show you 3 other strategies here. Now, one of the things about technical analysis is generally you're going to be looking for patterns within pricing data or patterns across like average time periods, things along those lines. So just to illustrate this point, let's look at one firm, Microsoft. And what we're going to do is filter any sort of observation that has a symbol equal to MSFT from the equity panel datasets. And you'll notice all this data is the exact same data from the equity panel 2 dataset, but it's all for a single firm. So this is no longer a panel dataset, but a time series dataset, because we're tracking the same unit of observation across time. Well, after we have our single unit of observation that we care about, let's just try to plot some patterns. See if there are any buy or sell signals that we can generate from the pricing data. A lot of technical analysis is going to be heavily dependent upon figures that you produce. So let's do this, but first focus on moving averages. Moving averages are generally going to be super simple to make inferences based upon, but as you'll see here, it's going to be kind of user dependent based upon which average you think is the best indicator. So we'll use ggplot as we have before. We're going to base everything that follows off the MSFT dataset. And what I want to do is plot 3 lines. One for the market prices, one for a 10-day moving average, and one for a 45-day moving average. To make a distinction between each of these, I'm going to let the 10-day moving average be red and the 45-day moving average be blue, and make the overall theme black and white. Center my plot title as we have before, and give a title to the plot. These are all options. You can make them be whatever. You can also make the color for these plots be whatever you want, but I like the red and blue distinction. Whenever I run this, you'll notice we get a new plot here in the lower right hand quadrants. And if I zoom in, you see we get this nice picture with 3 different time series. The black one is the longest because it is just raw price data. The 10-day moving average is a little bit shorter, which makes sense because it does not have data populated before the 10th trading day. And the blue is the shortest because it doesn't have data populated until the 45th trading day. Now, once again, I want you to remember I am not a technical analyst. This is not something I do on a day-to-day basis. So if you're interested in learning more about what the potential signals are, please reference those who are experts in this type of analysis. But generally, the rule of thumb is whenever we plot prices against moving averages of those prices, we could potentially generate buy and sell signals. So for example, if we focus on, let's say the black line and the blue line, and if we look over after July 2023 to, let's say, October 2023, where the blue line, or where the black line crosses over the blue line, we could have a sell signal when the prices go below the blue line, and we could have a buy signal when prices go above the blue line. And you'll notice that the timing of these buy and sell signals is going to be totally dependent upon which line you choose, right? Because the blue line is perpetually below the black line up until this point. But the red line has a lot more variation, right? So we could have a sell signal here in the beginning, and then we get a small buy signal and another sell signal and a buy signal, where it seems like we have a small run-up for about a month or so, where we get another sell signal and then a buy signal as the prices are breaking through on their way up over the moving averages, or breakdowns as a price goes below the moving average. So this is a perfect example of how technical analysis can, or not just can be, it is subjective to a certain degree, because 2 different simple moving averages produce different types of buy and sell signals. However, it is a simple way to generate a potential trading strategy. based upon technical analysis. A second type of technical analysis figure is based off of what we call Bollinger Bands. These are helpful because they could foretell impending reversals. In order to do this, we're going to need to build on the ggplot framework with a handful of new inputs and a new function, a new geom that comes from the tidyquant package. Ultimately, these are going to be plotted by the geom bbands for Bollinger Bands function. But before we get here, you absolutely need to tell ggplot this information. As always, we're going to feed ggplot the dataset where our data comes from, which here is the MSFT dataset. And then we need to give it a lot of aesthetics, where X is going to be our date, that's our time series dimension. Y is our close price. Open is going to be our open price. High is our high price. Low is our low, and close is our close. So that seems pretty straightforward. However, that's only because we downloaded data from Yahoo Finance. Other data sets may define this data differently or have different names for it. So if you're using the tidyquant package, just be cognizant of that going forward. And now for geom bbands, we'll say our new aesthetic that we're going to build upon, the previous aesthetic is an X for date and a Y for an adjusted column, which actually, let me change the first Y to be adjusted just to be consistent. And we'll make our close price adjusted as well. And I think this should work. But there are a couple more things we need to feed into the bbands function. One for MAFun, an SD, and an N. Well, if you notice this, MAFun looks really similar to maybe the abbreviation for moving average function, which if that's what you're thinking, you'd be correct. Because SMA is something that we used previously up here above line 45, where we have the simple moving average computation. And that's going to be, this is one of the places that you can change for your computation the Bollinger Bands. So if instead of a simple moving average, you want like an exponential moving average, you can tell the bbands function that that's what you want. We also need to define how much of a moving average you want. So you could do a 10-day, 30-day, 45, 250, whatever you want. And SD is going to be standard deviations. Or, in other words, SD is the amount of spread that you're going to use in your predictions of impending reversals. This is a little more technical on the technical analysis side, so feel free to look up more information after watching this video if you want more details regarding that. Everything that follows are just the normal options that we've grown to know and love. So now if we run this, you'll notice we get an interesting looking figure with some red and blue lines and some shaded areas. Typically with Bollinger Bands, our goal is to try to foretell impending reversals in prices, whereas our center line starts to get closer to the top or closer to the bottom, it could tell us that the stock is going to start going the opposite way in prices. Now for this time series, we don't really get any of those interesting patterns, so the Bollinger Bands are really just telling us, hey, this price structure is pretty random. Like it's not, doesn't seem to have any patterns of impending reversals following long downturns or long periods of upward climbing. It just is pretty random. But for other stocks, maybe especially for the more illiquid ones, this pattern is going to be a little more interesting. And now lastly, I just want to hit on this idea of the relative strength index. This is a cool trading strategy that is used to tell if a stock is potentially overbought or oversold, which means this is one way to measure the potential trading biases that investors have for a particular stock, where if it seems as if investors are just hating on a stock for no reason, it could potentially be oversold, which means markets should correct after a certain point and provide an opportunity for you to profit on the climb, and vice versa. Now what we're going to do in order to compute the relative strength index is use Tidyquant's RSI function. We're going to use this on our adjusted close prices, and we're going to compute the RSI over a 14-day window. You could do this over any window, 30-day, 45, 255. Just make the argument for whatever it is in your own applications. And generally, an RSI greater than 70 implies that a stock is overbought. An RSI below 30 means a stock is oversold. And once we get that data, once we make that computation, we can plot it using ggplot. Nothing fancy here. ggplot on the MSFT dataset, where my X dimension is my date, Y is RSI. I'm going to make a line based on this data, and then I'm going to put a horizontal line at Y equals 30. I'm going to color it green, make it dashed. Another horizontal line at 70, where my line type is dashed and my color is red. And I'm going to give it the title Microsoft Relative Strength Index. And when I plot this, you'll notice a couple things. Actually, let me do this first, just to make my figures consistent. So you'll notice we have we have two bands, a red line at 70, a green line at 30. Recall that RSI over 70 means the stock is overbought. RSI below 30 means the stock is oversold. So in theory, whenever stocks go above an RSI of 70, it should be followed by a period of selling where prices are going to reverse and markets are going to correct the price closer to their fundamental value, and vice versa for if a stock is oversold. And you can see Microsoft's RSI stays pretty consistently above 50 within the two bands. But interestingly, whenever a stock is, or whenever the prices are above 70, it tends to come down back underneath 70 pretty quickly. We do have this little period here where it goes up, goes down, goes back up, goes down, up, back down, up, back down, and like the seesaw pattern, and a small period of persistency closer to the end of our time series, But for the most part, after the stocks go above an RSI of 70, or the price goes above an RSI of 70, the market corrects and brings it back down, sometimes pretty drastically. But that's it. Once again, my goal here is not to make you a technical analyst or persuade or dissuade you on this type of trading strategy, or this pricing strategy rather. Really, my goal here is to show you some ways that you can perform technical analysis in R, and also to show you an easy, quick way to get a lot of stock data really quickly, really easily, and free, which is the best thing. As always, if you have questions, shoot me an email, leave a comment on the video, and do the normal YouTube things, right? Like, follow, subscribe, yada, yada, yada. Um, but as always, if you have any questions, hit me up, and I look forward to the next video where we will continue our journey in R. Thanks, y'all.